Coca Cola have released their earnings for Q2 of 2022. We're going to be looking through these numbers right now and then taking that to my stock valuation spreadsheet to look at discounted free cash flow models and the Buffett-Graham intrinsic value model to see if this stock is a buy off their most up-to-date earnings. But before we get into that, Coca-Cola, let's go to the daily chart, is down actually 1.5%. Coca-Cola here is the blue line, $62.25 a share. The reason why I have the S&P 500 up is if we compare Coke over the year, Coke is up almost 9% and the S&P 500 is down almost 10%. So Coke is beating the market. Is this the right time to buy? Well, let's get into it. So firstly, we want to look at the revenues for Coke, and they are up on the quarter. We have the 3 months ended 21 and the 3 months ended in 22, and it has gone from 10.1 billion to 11.3. So that is excellent to see. Revenue is up. So if I go to my stock sheet here, I have Coca-Cola already added. I've got the price, market cap, PE, earnings per share, shares, dividend, $1.76, 2.83% dividend. And we have the yearly results of Coke here up to the trailing 12 months, but not including the most recent numbers because they just came out yesterday. So we're going to add them in right now. So I've added this part for quarterly updates. And the previous number for revenue was 11.3 billion. So overall, that puts the trailing 12 months at 41.3 billion. So it is increasing, which is excellent to see. Next, we're going to look at the net income, which is here net income attributable share owners of a Coca-Cola company. And it is down 2.6 billion to 1.9. And why is this? Well, you can see the costs of goods sold has increased quite dramatically and other things as well. So overall, that has meant that there's less profit for Coke shareholders. So let's add that number in there. And that was 1950123. Lots of zeros. Oh, too many zeros. That's 119 billion. That would be much nicer. So they've got 9.5 billion in profit, which is decreasing from 2021, so that is down. And finally, what I like to look at is, well, I do like to look at the free cash flow, but I also like to look at the shares outstanding. What's happened with shares? They have actually issued more shares, which is rare for Coke. This is negative because if you have one share of a company and there's 10 shares, you own 10%. If they then issue another 10 shares, there's 20, you would then only own 5% of this company. But if they bought those back, they bought those 10 back and then bought another 5, there'd be 5 and you'd own 20%. So you want a larger piece of the pie, but you can see here, Coke has issued more shares. Not many, but they have still issued them. Next, what we're going to go is the cash flow statement and look at the free cash flow. Now, how do we get free cash flow? Well, it's cash from operating activities minus capital expenditures. Capital expenditures in this rate is purchases of property and equipment, which is this line here. So net cash provided from operating activities is down again, 5.5 billion to 4.5, and the capex is relatively flat. So that's about, what, 4.5 billion in free cash flow, but we'll just add this in anyway. So I'll go back to my sheet. And we said that the capex was 33 million. So let me just add that. And then we want to add the operating activities, which is 4.546 billion. And oh, I didn't actually add that in. That minus that gives us the most recent. And then we have a free cash flow of 11.285 billion, which is less than the previous years, but still increasing. There you go. There's Coke on the 255-day chart. If we go on the 1,000-day chart, up even higher. But if we go a bit more recently, we'll go 100 days. You can see that it is, well, it's still up. There has been some down, but Coke has been doing very well recently. So let's go to my earnings and my discounted free cash flow model and my Buffett-Graham intrinsic value model. What does this tell us about the stock? Well, this is based on the more recent earnings. As you can see, we've got the trailing 12 months updated. And this has a buy price of, let me just do the averages first. That is what I normally look at. It actually has the calculated stock price at $75 a share because we've calculated the future free cash flows based off the net income and the revenue. We've estimated the revenue out. Now, first thing I like to see here is the averages here is about 2%, but I think that number is a little bit low as we had a dip in 2020. I would say let's go off the most recent number and say it's about 7% increase. Net income margins for Coke have been relatively even, but once again, I would say 2018 is a bit more of a outlier. So let's just bring that up to 23%, not a massive difference. And the net income to free cash flow ratio, I think once again, the averages are okay here. So what does that give us? $92 a share. So that is definitely a buy. Next, we look at the Buffer Graham intrinsic value model. This takes in earnings per share and expected growth rate into account. Now, if we go here, this will give us the analyst's expectation of Coca Cola's growth rate, and the next 5 years is 5.95%. So let me add that in here, 5.95%. And interestingly enough, it has a fair value of $46 a share. So the Buffer Graham intrinsic value model does not like this stock. It thinks it's quite overvalued at the minute, and the reason for this is this relatively low earnings per share due to its price. But discounted free cash flow really likes this stock. So if we were to take sort of a rough average in the middle, it would say that the stock is about fairly valued, but probably definitely a buy based on discounted free cash flow. Right, guys, thanks for watching. Please give a like on the video if you enjoyed it, and I'll catch you guys next time.